Welcome to the Real Estate Espresso Podcast, your morning shot of what's new in the world of real estate investing. I'm your host, Victor Menashe. On today's show, we're talking about a new report emerging from the European Union. Banking in the EU is highly regulated. Governments have the ability to inspect financial records at virtually any bank or brokerage house if they suspect something's improper. Not surprisingly, these governments and the European Union as a whole are trying to figure out what to do about new technology. And on January 31st, the European Supervisory Authority, which oversees the Banking Authority, the European Insurance and Pensions Authority, and the European Securities and Markets Authority, they issued a position paper. The body issued a response to a February 2021 call for advice on digital finance and related issues. This 109-page document outlines how the regulator is concerned with the rapidly evolving picture of distributed financial services. The regulator is used to financial services flowing through a manageable number of relatively centralized institutions like banks and brokerage houses and publicly listed stock exchanges. Here's the punchline. European Union's regulators are completely unable to assess the risk consumers face on the new services that they have no visibility of. They claim that new financial services businesses might harm consumers, especially those with lower levels of financial or digital literacy. They made a bunch of recommendations. The first is that the Commission take a holistic approach to the regulation and supervision of fragmented value chains. And they further outlined a total of 8 recommendations. The recommendation is that the Commission ensures that disclosure requirements in the EU law are fit for the digital age, and they want to bring forward recommendations for a review of distance marketing of consumer financial services, bearing in mind that the regulatory authority might provide sector-specific recommendations as they get deeper into it. One of the recommendations on the Commission is to enhance consumer protection to address risks of mis-selling, in particular for products that are tied together or bundled, as well as to overcome potential weaknesses in complaint handling processes at the European Union level. In the 109-page document, they don't do much except wring their hands in worry over something that's been rapidly becoming mainstream over the past 5 years. Decentralized finance takes power from financial gatekeepers like banks and stock exchanges, and it puts it in the hands of individuals. And in that sense, some of those problems the report points to are actually features of the technology, not problems. Yes, it absolutely means that individuals need to take more responsibility for understanding their investment and to understand how the financial technology works. Fragmentation of financial value chains creates incentives for firms to produce new forms of cooperation in the form of mixed activity groups that offer customers both financial and non-financial services. Some of those groups include the big tech companies like Facebook and Google. They already have a strong presence in the payments sector. And these companies have the potential to gain market share quickly in other financial services because of their large customer base. We've seen an example of these types of partnerships already. These same groups, whose core competencies lie mainly outside financial services, might use partnerships to create additional layers on top of existing financial infrastructure, to leverage their network effects and their superior data collection to create one-stop shops for retail products and services. Companies that are deep in social media like Facebook, now renamed Meta, Google, and Twitter could gain significant advantage by bundling of financial and non-financial services. Apple's already drifted into the world of payment processing. Could Google, Meta, and others do the same? Absolutely. But these are big names and they're easy for a regulator to target. What about an app that has no central database and is strictly using blockchain technology? How will governments oversee those transactions? There's a lot of services being built on top of the Ethereum blockchain. I expect governments would want to oversee all of these as well. Another area of risk is not new. Authors of the report acknowledge that even with the quasi-centralized systems in place today, there's a tremendous amount of use of outsourcing in the banking sector. Relying on third-party services, and particularly outsourcing, is not a new phenomenon in financial services. These institutions have always cooperated with and engaged services from other financial and non-financial companies, many of them outside geographic control of the European Union. And that's been the subject of EU regulatory requirements and supervision for quite some time. So what does it all mean? It means that the EU is playing catch-up, as are governments all over the world. We've seen governments very slow to respond to technology. For example, it's taken nearly 3 decades since the widespread advent of the internet for governments to even figure out how to get major platforms to collect sales taxes. It's easy to assume that new technologies that are not covered by regulations will be exempt from regulation. While regulation may be absent for a period of time, creating a false sense of security for those new entrants, That lack of regulation is strictly temporary. When it arrives, you can expect a changing landscape. As you think about that, have an awesome rest of your day. Go make some great things happen. We'll talk to you again tomorrow.